Welcome to the deep dive. Today, we're digging into Steel Dynamics' latest earnings, Q2 2025. And there's more here than just the usual numbers.
Absolutely. We're going beyond the press release, beyond the headlines from the call.
Yeah, we want to really unpack the strategy, the bigger picture shaping up.
Exactly. Our mission here is to find those crucial insights, maybe some surprising connections, things that really matter if you're trying to understand the industrial metal space.
Yeah.
And, get you thinking critically too.
Okay, let's unpack this then. Starting with the top line numbers, the Q2 financials. What jumped out immediately?
Well, the headlines were pretty solid. Net sales, $4.6 billion.
Right. And net income came in at $299 million.
Yeah, that's $2.01 per diluted share. Adjusted EBITDA was $533 million.
And what's interesting is that sequential improvement, right, up from Q1.
Definitely. And look at the cash flow from operations strong at $302 million.
Even after paying down debt, that $400 million in senior notes.
And buying back $200 million in shares. They still have, what, $1.9 billion in liquidity? Pretty robust.
So these aren't just numbers on a page. What's the story they tell?
Well, you saw that 39% sequential jump in consolidated operating income. That's significant.
And EBITDA up 19%.
Right. And that was really driven by expanding margins across their steel business. It wasn't just one thing.
It speaks to efficiency, maybe.
Efficiency and strategy. I mean, look at their 3-year after-tax ROIC, return on invested capital.
Yeah.
It's sitting at 17%.
Wow, 17% in this industry. That's quite something.
It really is. It shows, consistently smart capital allocation, even with all the trade uncertainty floating around.
Okay, let's drill down into the core steel operations then. That's the engine room, really.
Absolutely. And it performed very well. Operating income there was $382 million.
Which is, what, a 66% increase from Q1?
Exactly. Huge jump. And the reason, pretty straightforward, actually.
Selling prices versus scrap costs.
Bingo. Average realized selling prices went up $136 a ton, hitting $1,134. But scrap costs, only up $22 per ton. That's margin expansion right there.
Makes sense. And shipments, were they holding steady?
Yeah, total steel shipments were 3.3 million tons. You saw 930,000 tons of hot rolled, about 114,000 cold rolled, and a really big number for coated 1.387 million tons.
Now, within steel, the Sinton Mill in Texas always gets attention. How did that play out?
The Sinton story. It's interesting because its utilization was lower, 71%.
Compared to the industry at 77%, and SDI overall was higher too?
Right, SDI's overall rate was 85%. But even at 71%, Sinton's earnings improved sequentially.
How did they manage that with lower utilization? Was there a specific challenge?
There was. They had this vendor oxygen supply issue. It actually cut shipments by, they estimate, about 55,000 tons over roughly 65 days.
Ouch. But that's resolved now.
Fully resolved, yes.
Right.
And the fact they still improved earnings despite that hit, I mean, it really demonstrates their operational agility. They can handle these curveballs.
So looking forward for Sinton, what's the outlook? Sounds like things are ramping up.
Very much so. The expectation is for a, quote, steep acceleration of profitability for the rest of this year and into next.
Driven by volume
And getting more higher value products out the door. They're pushing hard on product development API grades for pipe, high strength stuff like grade 100, 110, pressure vessel quality steel.
So more specialized applications.
Exactly. And qualifying more products for automotive OEMs. Plus, those value-added coating lines at Sinton are shipping more too. It's all moving up the value chain.
Okay, stepping back to the wider steel market, inventories are lean, you mentioned.
Generally, yes. Domestic inventories seem pretty tight overall.
But there was that issue with coated flat-rolled steel, an inventory overhang.
There was, yeah. That did put some pressure on volume and pricing for a bit. But the good news for them is they've gotten favorable preliminary rulings on some trade cases countervailing and anti-dumping.
Ah, okay. Final rulings expected soon.
Before September, they said. That plus the Section 232 tariffs that were announced. It's all expected to boost demand for U.S.-produced steel, especially the lower carbon kind.
Right, the lower carbon angle. Let's talk automotive. Production forecasts dipped a bit, right? Due to trade talk.
Yeah, North American estimates were tweaked down slightly. But here's the thing for Steel Dynamics. Their specific auto customers seem stable. Actually, they see growth opportunities there.
How so?
They've really positioned themselves as a key supplier, especially for the U.S. plants of European and Asian automakers.
Because of the lower carbon steel.
That's a huge part of it. Their current and planned future superior carbon content capabilities, as they put it.
Yeah.
It's clearly resonating. I mean, they won that Volkswagen Global Group Award for Sustainability. that's not just talk.
That sustainability piece seems critical. How big an advantage is that really on a global scale?
Oh, it's becoming massive. Think about it. All their mills now have this Global Steel Climate Council certification.
Which gives customers what? More transparency.
Exactly. Confidence that they're sourcing steel with lower embodied carbon. So SDI isn't just competing on price or quality anymore. They're competing on sustainability credentials.
And in today's market, that can unlock specific demand, maybe even premium pricing.
Absolutely.
Right.
Especially from customers laser-focused on their own environmental goals, their own Scope 3 emissions. It helps secure longer-term business.
Okay, let's pivot to the other parts of the business, the synergistic parts, starting with metals recycling.
Right. Record quarterly shipments there, which is impressive.
Although operating income dipped a bit because of lower scrap prices.
Yeah, ferrous pricing was down.
Yeah.
Primes dropped about $50 a ton. Other grades, maybe $80. But the key here is the strategic value of this platform.
How so?
Well, they're North America's largest metals recycler, ferrous and non-ferrous. This directly feeds their steel mills, especially with the increased capacity, and crucially, it's going to feed the new aluminum operations too.
So it creates a kind of internal supply chain.
Precisely. They're using new tech to separate materials better, getting more access to recycled aluminum. It cuts supply risk and lets them use more recycled content. It's a virtuous cycle, really cost-effective and green.
And the other internal engine, steel fabrication, how did they fare?
Fabrication income was $93 million. Lower than Q1, yes.
Why was that?
Mainly margin compression. Steel substrate costs went up, but their selling prices softened a little.
But the orders look strong.
Very strong. The order backlog is up 15% since the start of the year. It now stretches into 2026.
Wow, into 2026 already. And pricing is holding up on those new orders.
Relatively stable for joist and deck bookings, yes. This suggests they're hitting an inflection point in profitability, as they called it.
So expect improvement in Q3, driven by...
Volume, mainly, and the underlying demand drivers are solid. Manufacturing coming back onshore, big private projects, think data centers, battery plants, plus all the public infrastructure spending.
And this fabrication business helps their steel side too, right?
Massively. It provides a guaranteed outlet for a good chunk of their steel volume. It cushions the blow when steel prices are lower externally and lets them run their mills at higher rates through the cycle compared to competitors. It's a smart internal hedge.
Okay, now, the really big news, I think. The move into aluminum.
Yeah, this is where it gets really interesting.
They actually shipped their first commercial quality aluminum flat-rolled coils, June 16th. That's a huge milestone.
Phenomenal accomplishment, really.
Right.
Building something that complex that quickly.
So financially, how does this aluminum ramp-up look? It's going to cost money initially, right?
Yeah, absolutely. Operating losses for aluminum were $69 million in the first half of the year.
And the forecast for the rest of 2025?
They're guiding for losses around $40 million in Q3, then improving to maybe $15 to $20 million loss in Q4.
But they expect to hit EBITDA positive when?
Before the end of 2025. On a monthly basis, that is. Which is pretty aggressive.
That does seem fast. And interest expense will tick up too.
Yeah, they'll stop capitalizing the interest related to the project. So expect interest expense to increase maybe $30 million in Q3, $45 million in Q4. It's the cost of getting this major new business online.
What makes this bet on aluminum so compelling for them? What's the market gap?
It's significant. There's a domestic supply deficit for aluminum sheet, over 1.4 million tons, they estimate.
And that gap is growing.
Forecasted to grow, yes. Historically, imports filled that gap. But those imports were already high cost. And now...
Tariffs went up.
Exactly. From 10% in 2024 to 50% now. That makes domestic production look a lot more attractive.
They drew this comparison to when they first entered the steel market, like 30 years ago. What's the parallel there?
Well, what's fascinating is they see the same pattern. An industry with older, maybe less efficient assets, companies that haven't reinvested aggressively.
And SDI comes in with brand new, state-of-the-art kit.
Pretty much. They leverage their know-how in construction, running complex melting, rolling, finishing lines, and that performance-driven culture. They expect to drive higher efficiency, lower costs, basically grab a significant competitive position right out of the gate. It's the same playbook, different metal.
And the customer overlap helps too, presumably.
Huge help. They said 2/3 of their flat-rolled steel customers also use aluminum sheet. So the commercial alignment is excellent.
Plus, they get into a new market, the beverage can sector.
Right, which tends to be countercyclical, adds diversification.
So how's the actual ramp-up progressing? Are the machines running?
They are. 3 of the 4 milk cast houses are commissioned, making the right kinds of ingots, 3000 series, 11,000 series for industrial can auto uses.
Hot mill, cold mill.
On schedule, producing 3000 series industrial coils successfully. Based on how things are going, they think they'll exit 2025 running at maybe 40% to 50% utilization.
And hitting 75% by the end of 2026.
That's the target, yeah, as they get all the product certifications lined up. It seems like a very methodical, step-by-step ramp-up.
Okay, another future-focused initiative, biocarbon. What's the latest there?
That facility is in commissioning right now. They expect to start shipping product later in Q3.
And the impact, what does this do for them?
It's potentially profound, especially for their carbon footprint. This first plant, they believe, could cut their Scope 1 steelmaking emissions by up to 35%.
35%? How?
By replacing a large chunk of the anthracite coal they currently use in their electric arc furnaces.
And it's modular, meaning they can build more?
That's the idea. Potential for future growth, a path towards even lower carbon iron units, and it creates unique supply chain opportunities for their customers, especially in automotive.
And it's cheaper than other decarbonization options.
Considerably less expensive, they argue, than what some competitors might face. It's an actionable, near-term solution, a real head start.
So let's zoom out. Tying all these threads together, steel, recycling, fabrication, aluminum, biocarbon, what's the overarching strategy?
It boils down to disciplined investment, driving strong and growing cash generation. They highlighted how their free cash flow profile has fundamentally changed.
Right, that jump from an average of, $540 million a year to $3 billion, excluding the big Sinton and aluminum spends.
Exactly. That's a massive war chest. It gives them incredible flexibility.
And they see the policy landscape shifting in their favor.
They do. These strategic mercantilist policies, as they term them, the trade case rulings, the Section 232 tariffs, they see it creating a fairer playing field for domestic producers.
Including tariffs on fabricated steel now, too.
Yeah, that was a crucial point, something that's apparently plagued the domestic guys for years. So policy is helping reshape supply chains towards North America.
And you add the demand tailwinds, the reshoring, the AI boom driving data center construction.
Cloud computing, chip factories, battery plants. It all needs steel, it needs aluminum, and there's both public and private money chasing these projects.
So, last piece of the puzzle, decarbonization as a competitive edge.
Absolutely. The global push to decarbonize is going to make producing metal more expensive for many machineries. It'll steepen that cost curve.
But SDI, with its EAF model, its recycling, its biocarbon, they're positioned better.
Significantly better, they believe. It gives them an advantage to potentially gain market share, maybe improve margins, their whole circular model offering lower carbon solutions. It's not just environmentalism, it's smart business that builds resilience through market cycles.
So quite a journey we took there. From the solid Q2 numbers through the steel operations resilience, the fabrication strength, the recycling loop, and then these big strategic pushes into aluminum and biocarbon.
Yeah, it's clear they're not just riding waves. They're actively building a very different kind of metals company for the future.
A future shaped by regional supply chains, sustainability demands.
Definitely. Which leads to maybe a final thought for you, the listener, to chew on.
Go for it.
Given this clear shift we're seeing in regionalization, the absolute necessity of lower carbon production, what kind of long-term, almost structural advantage do you think companies like Steel Dynamics with this deeply integrated, sustainable model are actually building, not just for their own bottom line, but for their customers and the whole industrial ecosystem they operate in? Something to think about.